be sweet nice. Alright, okay, so we'll kickstart officially. So we will be using today's this book today. Okay, so for all the content lessons, please prepare your book. If you don't have, go and find yours. And make sure it's the latest copy. The latest copy will have a sticker on top for those who receive the book by mail. Okay, so we will wait for Dylan to be back. Thanks. Great. Then do you have your book? Do you have a writing pen with you? So today we'll be utilizing your book. Okay, so this is probably one of the few times you have attended an actual content lesson with Mr. Teo, right? And most of the time it is like I think Dylan can speak for himself, right? Most of the time it's record. This is the actual time. Okay, but anyway, okay, so we'll be using the book. So I would like you guys to turn off your WhatsApp. Okay, I will join all of you. WhatsApp web especially. Okay, we don't need that for the next 2 hours. Okay, anything that you need my private attention, drop me under the chat function. Right? If not, okay, this is a pretty small intimate class. Just unmute and ask. Okay. So the next thing is enlarge my screen. Okay, I won't be doing any screen share. Okay, my screen will be this screen. So looking at my background, okay, what topic do you think is likely to be covered today? You want to utilize the chat or you want to unmute also can. The faster you participate, the faster we can end today's class.
ADAS.
ADAS close, okay, but we are doing something before ADAS. Hey, so good guess. Okay, so before ADAS, okay, you need to know national income accounting. Okay, ADS is the language to express that. Okay, which we will be covering that in maybe 2 weeks time. Okay, I believe it will be the Chinese New Year week on Sunday. Okay, that will be the week that you guys want to look out for. ADS will be covered then. So, okay, let me quickly run through what are our learning objectives today, and I hope we can end slightly earlier today. Right. So we have the first objective, okay, transition from micro to macro. Okay, so I will be covering later, okay, what we have, we'll be wrapping up all the micro stuff that we have done earlier, okay, and we will be moving on to macro. What are the things that you need to look out for macro? I will do a quick summary. Oh yes, and one more thing, okay, this is a for content summary lessons like that, okay, the content is meant to be concise, so please don't come and ask Mr. Teo, how come your notes don't have this, how come your notes don't have that? Okay, our notes are meant to be concise and exam focused. If you want depth, if you want more, then you look out for your lecture notes. I'll point out to you where you should reference your lecture notes along the way when we cover content related lessons. Okay, and moving on, okay, I will be covering the macro goals. Okay, so there are 4 macro goals for the H2 students. For my H1 students, you guys have 3 only. Okay, 1 lesser, I think is a discount, 25% discount. And not too bad, right? Okay, so we will be learning the usage of GDP. Right, okay, so what do we use GDP for? Later on, we'll find out what exactly GDP is. Yeah, I believe some of you might already have experienced national income accounting, so you're not new Okay, so it is more like a refresher. Some of my H2 students haven't even started. This is where I have to go really slow. Alright, we will be learning about the concepts of real and nominal GDP. Okay, this is exceptionally important. Later on when I cover, please don't take a nap. I will be covering the limitations of GDP. Okay, so this is also fairly important, especially for case studies. I will be advancing to the concept of standard of living. Okay, I believe all of you should be familiar with that by now, right? Okay, just that when I look at your exam scripts, I realize that it hasn't been tested before. Yeah, probably I missed out. Okay, but it will definitely come out. Right, okay, so we will be learning how to measure standard of living. Okay, I will be introducing alternate indicators here. Very, very important. Okay, especially when you're doing case studies, okay, the presence of indicators or the absence of them is, especially absence of them, is crucial. I will be covering how to compare standard of living across time. Okay, so across time and space, okay, these two are 2 concepts that you need to know. When I mean time, it's quite straightforward. Okay, from a time period to a time period. When I mean space, I don't mean ultra space or between planets. Okay, I mean what? between countries. Okay, so I'll be covering how do we compare SOL across space and the usage of PPP, okay, to compare SOL across space next week. So, anyone learn PPP already? Heard of PPP? Okay, Dylan learn PPP already? Okay, so probably you can share with us next week. Okay, so with that, okay, we shall look at the very first page. Let's refer to page 71, everyone. Okay, where is my here? Where is 71? Alright, so you can see that page 71 stated all the macro goals, okay, but we won't be using this for now. So with that, okay, I just want to cover, okay, there are three important things to look out for, okay, when we transit from micro to macro. Alright, so from micro to macro, okay, we are concerned about what? Okay, who is involved, right? So now, okay, for micro, we are more or less concerned about consumer, okay, and firms. Agreed? Okay, we use the demand and supply framework to illustrate, okay, how is resource allocated, okay, in an efficient manner. Okay, and how is price determined and quantity. Okay, and for my H2 students, we also learn how firms actually maximize profit, okay, with firms and decision. Okay, so these are the primary two economic agents involved. Of course, we also learn market failure. Then government will come in to correct. Okay, but okay, primarily we are looking at these two economic agents. But what about macro? Okay, which are the economic agents that are involved? Anyone? You can unmute, if not can type out. Yeah.
Household, is it one of them?
Household, what else? Alright, so in a nutshell, okay, we are looking out for, okay, the aggregation of all the respective demand. Okay, you realize that on the micro side, okay, we are concerned about specific market, right? Okay, the interaction between firms and consumer, okay, will determine the equilibrium price and quantity, okay, of a specific market, like what, like oil, like vegetable. Okay, but for macro, we are no longer concerned about specific markets. Okay, we are concerned about all the markets. So in a nutshell, we are taking a helicopter view. Okay, we are concerned about all the economic activities. Alright, so we are concerned about all your demand. Okay, and I use the word summation. This is summation. All of you are science students, most lah. Okay, you guys should know this familiar with this side. Okay, we are concerned about all the factor of productions involved. Okay, and I also want to emphasize a little bit more. Okay, and when we move on to summation of all your demand, in the future we will introduce the concept of AD. Just so someone brought up AD, right? So what are the components of AD? Quickly type out. What's AD? AD is what? Aggregate demand, right? So what are the components of AD?
CIG and X minus M.
Right. Okay, so what is CIG X minus M? Okay, we have consumer spending. Okay, we have investment or your firm spending. Okay, we have your government spending. Okay, and we have your net export spending. Net export means exports minus import. Okay, in the future, I will cover this all in depth. Okay, so all of this represents a specific aspect of the economy, one of the economic agents involved. Right, and for the summation of all your factor of production, okay, we will pretty much know this as aggregate supply, okay, where we cover AD and AS framework. Okay, so in order to have a good solid foundation for macro, okay, your understanding of micro has to be good. Okay, because everything stems from micro. Okay, it's just that we are looking from a helicopter perspective. Okay, is everyone good so far? Who is involved? Alright, so for the next part, okay, we'll be looking at the objectives. Alright, so for micro, which are the objectives that we are concerned about? Can y'all type out? Okay, or if y'all like, y'all can try unmute. Quickly, what are the two micro objectives?
Efficiency and equity.
Efficiency and equity, very good. Okay, efficiency and equity. Okay, but for macro, like what I've mentioned in page 71, okay, everyone please look at page 71. There are 4 goals included. Okay, H2 no need, H1 no need to know this. H1. Okay, for those who are H1 students, okay, please cross this out. So I will quiz you from time to time what are the macro goals, and you have to know them by heart. Okay, so I'll just quickly run through. We are concerned about strong economic growth, healthy employment or full employment. Some of the schools use these two terms interchangeably. Okay, and price stability. Alright, so you also have to know the problem. Okay, the flip side of the same coin, okay, the goal will give you the problem, right? Okay, so questions can be phrased from the perspective of goal or problem. Okay, these two have equal chances. Right, so you have to be concerned or look out for keywords. Okay, like, okay, I'm going to point out the opposite. Okay, and balance of payment is healthy balance of payment. Okay, so the opposite, okay, do you all know the opposite? Let's try. Okay, what is the opposite of economic growth? It starts with the word R though.
Recession.
Okay, recession, good. Okay, look out for keywords such as recession. What about price stability? Okay, Dylan, wanna try?
Inflation.
Yeah, inflation. Good. You guys know, but you already know already. Right? And for healthy and full employment, okay, the opposite will be unemployment. Alright, okay, so these are the few terms that you need to note. Okay, and then especially when we cover economic growth, I will be introducing you 2 sub-models under economic growth. Okay, that will encompass efficiency and equity. So efficiency and equity will be revisited under economic growth under a slightly different name. Okay, are you all familiar with the term? Have you all encountered that? Yeah. Okay, so I will briefly state. Okay, so you want to be concerned about sustainable growth and inclusive growth. Okay, these are the 2 terms that we'll be using to encompass efficiency and equity together with economic growth. So you realize that I touch and go a lot of things. Okay, so the whole idea is to give you a rough idea. It's not to solve. We can't solve all the problem in one single lesson. Agreed? Just take one problem at a time. So this is an overview lesson. All right, and the last approach that we want to be concerned about is the perspective of policies. All right, so we realize that for micro, the policies mainly revolve these 2: price mechanism, okay, and efficiency. Okay, to be more specific, okay, what are the pricing strategies, for instance, okay, for a firm? Okay, when demand of goods is price inelastic, that's one way to test. Another way is, for instance, okay, if a necessity good is priced excessively high, okay, what policies can we use to reduce the price of a good? So they are framed along this way, okay, that revolves around price mechanism. The other way that we are very, very familiar with is market failure, externality, right? Okay, and what are the policies that we use to correct externalities, like tax and subsidy? But in macro, we can drop all this. Okay, so this is the biggest difference. We don't need to know all this anymore. Okay, we will be learning what? Okay, what are the 2 branches of policies that we'll be concerned about? Anybody know? Yeah, I'll call this DSP and SSP. They are brother and sisters. Anyone want to try? Not sure? Alright, DSP stands for, not Deputy Superintendent. Okay, demand side policy. Okay, demand side policies. Okay, and SSP stands for supply side policies. Okay, of course, these are 2 very broad heading. Okay, there will be more covered under demand side policies such as fiscal policy, monetary policy, exchange rate policies. Okay, so all these will be learned. Okay, so on a good day, especially for my H1, okay, some of the policies may be removed from syllabus. Last year, it removed a few. Okay, I don't know what's going to happen this year. Okay, let's keep our fingers crossed. Okay, so everyone has a good idea on the overview. Okay, what we are going to be covering for the next 2 terms. Okay, so we won't be heading back to micro anytime sooner, especially only with the exception of lecture tests. Maybe lecture tests we'll revisit micro. Okay, but other than that, okay, it will be all macro centric, huh? So I want to bring your attention to what is GDP. Okay, let's flip to page 59. Okay, 59, everyone. Okay, for the viewers out there, if you have the book, okay, please use the book. Okay, it's called Economic in Minutes. If you don't have the book, you can probably get a copy from Popular. Okay, so page 59. GDP. Okay, so GDP is one of the entry indicators that we'll be learning. Okay, it's a measurement of what? Okay, so now let's learn the definition. Okay, very important. So I'm going to point out to you the 3 important aspects of GDP. Make sure you get it in your definition. So the first one that you want to be considering is your value of final goods and services. So what is the opposite of final? Beginning. Okay, in economics, if it is not final, then it is unfinished. They use the word unfinished or intermediary good. You probably hear these 2 terms before, they're used interchangeably. So in a nutshell, okay, they are factor of productions, okay, that you use to produce a final good. Okay, so for instance, okay, this is a water bottle. You guys can see, right? Okay, the intermediary good to produce this will probably be what? Plastic. Right? Unfinished plastics. So the reason why is it final and why you have to include the word final, okay, is because you don't want to have double counting. Okay, I believe your school notes will have covered double counting. Okay, so this is not important. It won't be tested in exam. Okay, so if you are not sure what is double counting, okay, just look at your school notes or do a Google search. Okay, what is double counting? I'm not going to cover that because there's no exam value for that. But the keyword here is final goods and services. Alright, the next one that you want to be concerned about is geographical boundary. Alright, so all the goods and services that are produced are constrained, okay, or bounded by space. Right? So they're typically countries. And the last part that you want to be concerned about is it must be bounded by type. Then we can measure, okay, the production of goods and services across a time period. Maybe 1 year, 2 years, 3 years. So far so good? So in most cases, we'll be using GDP. We will be hardly using GNP. Unless the data gives us GNP, then we use. If not, we don't use. Alright? So, the subtle difference between the two is not important. Okay, I don't think it's going to be tested anytime soon. But it's easy, so I'll just cover this. Okay, so the subtle difference between the two, GDP and GNP. GDP is bounded by space. GNP is bounded by nationality. So to give you an understanding, when we look at GDP, okay, we are concerned about the total values of goods and services produced within, let's say, Singapore. Right? And whoever that contributes to the production, regardless of nationality, Singaporeans, Americans in Singapore soil, they all contribute to GDP. But when we look at GNP, we are only concerned about what? We're only concerned about the specific nationality. Okay, so we are going to exclude Americans who is living in Singapore soil. And we are going to include, okay, the production of Singaporeans abroad. Okay, so this is a subtle difference. But in any case, not really important. Okay, so just know GDP by heart. Alright, so the next one, okay, that you want to be concerned about, okay, is the identity of GDP. Okay, so the identity of GDP, okay, it is removed I will use a bit of circular flow. It's not within H1 syllabus, okay, but I just want to touch on this a little bit, okay, because some of the students will ask me, Mr. Teo, why is it always on the x-axis on my AD and AS? I don't know whether you guys observe that. Sometimes I see real Y, sometimes I see real output, sometimes I see real GDP. Do you all see that? Okay, they are used interchangeably. So are they the same? Okay, so essentially they are the same. Okay, so I'm just going to prove it to you guys using the circular flow. Okay, circular flow is a H2 concept. H1 students no need to know. Okay, but okay, all we need to know is for the circular flow we are concerned about, we just need to look at this two. The relationship between household and firms. Okay, at the simplest level. Okay, we know that the household and firms are related like this. Household will provide, okay, the FOP to the firms, right? For them to produce goods and services. Okay, so you can see this. Okay, household provides the muscle, muscle. So firms, okay, will produce output. Okay, so most importantly is output here. Okay, and the output, okay, is equivalent to household spending, because whatever that is produced by the firms must be purchased by something else, right? Okay, and households are the ones that acquire the output, the output that's produced by the firms. And where do household acquire the income? No, income. Okay, because when household render factor out inputs to the firms, do they work for free? They don't, right? Okay, so firms will have to offer them income. So you can see that this three identity is the same. No matter you use output, expenditure, or income approach, it will tell you the same story. Whatever that is produced, it must be spent using somebody's income. Okay, so this is what it tells you. Okay, so don't be confused any further when you actually encounter different variations of GDP, Y, output, income, whatever, same. Okay, so we will be using the output approach a lot more. Okay, so focus on the output approach. So like I've said, okay, you can take down notes on the book. If not, you can flip to the back of the page, the book, and take down notes if you like. Okay, so this will be our notebook. Okay, I won't be issuing physical notes. Anything that I need you to take down, I'll ask you to take down. So are we good with GDP? Okay, the usage of GDP? Great. Now, okay, I'm going to go through an important concept of real GDP versus nominal GDP. So, can anyone tell me, okay, because it seems like all of you have learned, so what's the difference between real and nominal GDP? In one sentence. Let's say if your dad or your mom asks you, hey Dylan, what is real or nominal GDP? I see on the news, I don't know, I'm not sure. How?
Real GDP has like a base year for comparison, but nominal don't have.
Okay, so how? If you are the mom, what is it? What will you be thinking? Or the dad? What is base year, right? Now, okay, remember, okay, the way how you assess your understanding is, okay, whether you can summarize, okay, and you can explain it to your friends in a easy way. Okay, but it's a good approach. It's a good attempt. Don't get me wrong. Okay, I understand. Okay, but doesn't mean that okay a layman will understand. All right. Okay, so before we go through real and nominal, I want you to copy this down. Okay, on page is that page 59. Okay, what are some of the other terms that are used interchangeably? So in an exam, they won't be so generous. They won't tell you real or nominal. Okay, but they will use other terms to test you. Okay, so for real, you want to be looking out for constant price, GDP at constant price. or you want to look out for a base year, okay, which is what Dylan has mentioned. Okay, but what's the use of a base year? Later on, okay, we will look at that together. For nominal, we are looking out for these two terms: current price, GDP at current price, or GDP at market price. Okay, so you can copy them down beside, okay, the definitions of real and nominal GDP. Okay, so you can see that for real GDP, okay, just now in the definition, it actually tells you that the effects of general price level are removed. Okay, so it has been adjusted for inflation. Okay, I want to put this here. Adjusted for inflation. So what do we mean by adjusted for inflation? Then this is where, okay, I'm going to show you with a simple numerical case. Okay, what is adjustment for inflation? So let's identify, let's work with our first row first. Nominal case 1 and nominal case 2. So this is a time series data. This is a perfect illustration of time comparison across time. So we can see that these are the 3 years, okay, of, oh yes, I forgot just now I forgot something. Yeah, GDP. All right, let's go back to GDP. Okay, I'm so sorry. Okay, for comparison of GDP, okay, this is just an approximate. Okay, we realize that we are looking at the value of goods and services, right? Okay, so the total value can only be determined using price times quantity. Okay, this is consistent with micro, what we have learned, right? Expenditure, revenue is the same. But in macro, we are a little bit concerned. We are not concerned about any single price or any single market's output. Okay, we are concerned about the general price level. We use GPL, and the total production of an economy. We sum up all the production. Okay, so not too different from what we have learned in micro. Okay, we need this concept for this simple numerical illustration. Okay, so we can see that let's look at nominal case 1. We can see that the price for 3 years has remained relatively stable, right? Okay, this is an oversimplified hypothetical scenario, but it's good for understanding only. Okay, so let's accept that there's no change in price. Now we can observe that the production of the economy has actually went up, right? Okay, the increase is production from 4 to 8 production. So how do we extract the value of the GDP of each year? Okay, we multiply each column like that. Okay, and we get the nominal GDP. Are y'all following me? So this is case 1 where price is no change. No change in price. So case number 2 is the opposite. No change in production. Only the price increase. Okay, and we realize that we get the same outcome. So now, my question to both of you, or to all of you who are watching this, is which is the better case? Or are they the same? Which one do you think is better or same? Type it out, or you can unmute and try if you like. Maybe I'll get Zach. Would you like to try?
Is it the same? Because like the output is the same.
Output is the same. Same. So the value is the same. Okay, but if you have to pick one case to justify which one is seemingly better. Which one is seemingly better? Which one do y'all think is seemingly better? Case 2.
Is it the first case?
Why is it the first case?
Is it because there's more quantity?
Yeah, there's more production. Okay, and someone brought up case 2. Why is case 2 seemingly better? You brought up case 2, right? Well, why do you think case 2 is seemingly better?
There's a change in price.
Price went up. Alright, so I just want you all to be concerned. This is a very valid comparison. And this is why we are learning real versus nominal. So on surface, we see that the nominal values are the same, right? Okay, but the root cause of each of the year's nominal GDP is different. Okay, so case 1, we see that prices are relatively stable. There's increase in production. Case 2, we see that production is the same, okay, but price goes up. So if you have to make a choice, okay, same cannot be the correct answer. Okay, one of these has to be better. So for an economy, okay, we are concerned about what? The total productivity of the production. Okay, so having more goods and services is going to be more beneficial for the economy. Okay, more consumers can consume the good. So when prices goes up, okay, this creates another problem, which we have just now briefly covered, which is what Dylan mentioned earlier on, right? The I word, which is inflation. Okay, so when there is inflation, prices goes up, your production remains stagnant. Then in that case, okay, we can't tell whether the economy is necessarily better because there's the same amount of goods and services, okay, despite price going up. So when you look at your data, you don't normally see price and quantity. You only see nominal. Okay, maybe I'll show you an example. I'll fast forward. I'll show you. Do I have the question paper? Yep. Okay, so this is the question that we will be using. Okay, this is not a nominal data. I'm so sorry. Okay, but anyway, whenever you see case studies, okay, they will tell you the nominal GDP only, but they won't have the breakdown of the price and quantity. Okay, so we can't tell for sure, okay, whether is it a price effect or a quantity effect. We cannot isolate the effects. Okay, so when your nominal GDP goes up, it could be an effect of either quantity goes up or price goes up, okay, or both. Okay, but we are more concerned about the first two scenarios. Okay, so we cannot tell, and therefore there's a need to adjust for inflation. So now let's adjust for inflation and see what are the changes. Okay, when we convert them to real GDP, the whole idea is to fix the price level. You don't want price level to change. Okay, so therefore you want to look out for base year. So the extract will tell you which year is the base year. Whenever you see base year, there must be presence of real GDP. Another term that you often see is constant GDP. Okay, so constant GDP is actually seen in our practice question later. You see, constant. Constant means that it has been fixed to price of an earlier year. So an example is here. Okay, we see that the base year, let's say if we fix it at 2020, right? Okay, so you can see that 2020 will be the base year. All we need to do is to map it out to the next two cells. Okay, by hook or by crook, okay, you accept the price for the base year. And this just so happens to be the same as the first scenario, but there's a subtle difference. Okay, for the earlier case, can you realize that the price just happens to be the same across every year? Okay, but this one is manually fixed. Okay, they will 2021 and 2022 will take 2020's price level. Okay, quantity will have no change, will be the same. Okay, and you realize that, okay, this will be your real GDP. Okay, it just so happened that your real GDP's value and your nominal GDP's value for the first case is the same. Okay, but I'm going to show you the interesting part. So now, remember, okay, if we compare nominal case 2 and real case 2, okay, the base year is 2020, so this is $2, right? So this is where we are going to copy and paste. You see that? Okay, so 2021, okay, on a nominal basis is $4. Okay, but on a real basis, it will take on 2020 price. Do you see that? Okay, and same for 2022, same price. And if we were to multiply by the existing production, okay, that we have seen in nominal case 2, okay, 1, 1, 1 each, this will be your real GDP for each year. So now when you compare, then you have a good understanding, right? Okay, which case is going to be better? You see that after adjusting for inflation, okay, real case 1 is better than real case 2. Agreed? Okay, because real case 1, okay, there is greater increase in your productivity. Your real GDP goes up. Real case 2, once we fix all the price level, then with a stagnant productivity, your production remains the same. Okay, so this is what we call adjustment for inflation. Like I've said, you don't need to know, you don't need to understand, you don't need to copy this. It's just for understanding purpose. Okay, but it's a very powerful illustration to show you what do we mean by adjustment for inflation. Okay, so always look out for these 4 key terms. Okay, I will be testing you all next week again. Okay, so for real, look out for constant base year. For nominal, look out for current and market price. Current and market reflects the latest. In a nutshell. So far so good? Good. Okay, I'm going to move on, okay, to limitations of GDP. Okay, you can refer to page 69. Okay, you can add on some things from there. Okay, page 69, you can see that some of the limitations of GDP and material standard of living are overlapping. Okay, so I will just... Okay, so this is covered in the book already. Okay, so I just need you to copy, okay, the extra things that I have not illustrated. Okay, non-market activities are covered in the book. Okay, so you may want to jot down these two. Okay, so you are expected to use this as a limitation for GDP. Okay, so from time to time, especially for standard of living questions, they are very popular. Alright, so all these 3, okay, should be well addressed, okay, in your lecture notes. Alright, so I'm just going to briefly cover. Okay, so for underground and illegal economy, okay, illegal economy or illegal activity is a subset. Okay, subset of underground economy. So what's the whole idea behind underground and illegal activities or economy? Right, so underground economy means what? Okay, it means that there are goods and services that are produced, they are not captured, okay, by our standard accounting system of GDP. They are somehow omitted. Okay, so a good example, okay, that you probably can relate to in your earlier days. Remember in your primary school, secondary school, you have home tutors coming to your house, right? Agreed? At the end of every month, okay, your mom and dad, okay, will pay the tutor, okay, probably a graduate tutor or undergrad, right? So the undergrad tutor, okay, will probably keep the payment. Okay, there is no incentive to report as an income, right? If you report as an income, you'll get taxed. Agreed? So these are some of the underground economy that's happening. Or maybe the amount is too small, don't need to capture. Alright, so in modern days, underground economy also encompasses what? Okay, anybody heard of cryptocurrency? Should have heard of that, Okay, so cryptocurrency also falls under underground economy. They're not regulated. But are they illegal? I think it's a grey line. Okay, it's not illegal, but it's just unregulated. Okay, so things that are largely unregulated will fall under underground economy. Okay, so illegal, okay, is a subset. Why? Because illegal activities cannot be reported. That's why it has to stay underground. So what are some of the examples that are of illegal activities that you know, that you're aware of? Okay, what things are illegal, cannot do? Okay, you probably cannot buy an alcohol after 18, after 21, after 10:30, right? Okay, you cannot buy alcohol below, is it 18 or 21? 18, right? Cigarettes is
18.
Cigarettes is below above 21, right? Okay, the buying and selling of drugs, firearms are all these illegal activities, right? So the hardest is actually these are non-market activities. Okay, this is hardly tested. Okay, but I will just briefly cover. Okay, so what are non-market activities? Right, non-market activities are activities that are difficult to assign a monetary value, but they are yet still important. Okay, I believe your school lecturers will use the example of what? Housewife, right? Or housekeeper, housewife. If your mom, especially if your mom is a housewife, and how would you value her services making dinner for you? How would you value her services waking you up for exam? Is it important? It's important, right? Okay, but can we attach a dollar and cent value to that? Very hard. Huh? Okay, so this is an example for non-market activities. Alright, so in a nutshell, all you need to know is all these three, okay, will lead to understatement of your GDP. Because your GDP cannot capture these three. Now, some economies, they have very huge illegal activities, underground economy, like North Korea. There's a huge black market. Okay, so hey, you need to know that. Okay, which brings us to the next concept of standard of living. Okay, I need you guys to flip to page 59. Okay, we'll be looking at standard of living. Okay, be familiar with the definition first. Alright, so make sure you get the definition right. Okay, so standard of living, we are concerned about the level of well-being of an average person. Remember, an average person. How do we get the average person? Okay, we have to divide the total well-being across the entire country's population. Then we get average. So the concept of population is present here. The next part is standard of living. Okay, please highlight this. Standard of living will by hook or by crook have material and non-material standard of living. I'll go on in depth to talk about that. So when you address in your case study or in your essay, don't blatantly use SOL. You have to subcategorize them into material and non-material, okay, and to elaborate both of them in depth. Alright? So, both the summation of your material and non-material, okay, will give you your overall standard of living. So what is material standard of living? Okay, we can see that material standard of living tells us the quality or the quantity of goods and services available for consumption. This is quite straightforward. Okay, and some of the schools use the word, the T word, or what we call tangible aspect. Okay, whereas non-material standard of living is a little bit more abstract. Okay, they are not really concerned about goods and services, but qualitative aspect of your life. Right? For instance, okay, we have, or I'll put this, intangible aspects of your life. So, okay, what other aspects other than stress level? You see, all my A-level students like to use this example of stress level. Okay, so why? We are studying very stressed, right? Okay, this will worsen our non-material standard of living. Okay, pollution level is going to harm your health, right? So, okay, despite having ample goods and services to consume, okay, but if you're living in a hazardous environment, okay, your non-material standard of living, okay, may be worsened off. So, what are some of the other aspects of non-material standard of living can you guys think of? Come, one each. There are a lot, inexhaustive one.
Wait, can we say externality for this one?
Externality is captured here already.
Oh,
Right, externality is a micro concept that we talk about allocative efficiency. Now we are looking at the perspective of an average citizen. An average citizen won't care about externality, right? Only the society cares about externality. Okay, so don't need, you can drop that, stick to pollution. What else is going to affect your quality of life other than goods and services? Okay, maybe access to healthcare, right? What else? There's a lot more. Crime rate. Okay, what happens when there's excessive crime rate? Okay, then the city is unsafe, right? Then you will feel scared. Will it lead to a worsening of your standard of living or material aspect? So anything that cannot be captured with dollar and cents will go here. Generally. There's a lot. So my art students are leisure. Okay, good. Leisure time. Okay, the opposite of leisure is working time. Okay, so very good. And we also need to know how to measure them. Okay, so for the measurement, okay, let's look out for page 69, everyone. Okay, so for page 69, we actually see that here. Sorry, I woke up with a sinus, I don't know why. Okay, so your material standard of living is primarily captured by real GDP per capita. Okay, this is very important. We are concerned about how your GDP is distributed across the population. Remember just how I talked about income? How is your real income distributed across the population? Alright, so if you look at some of the case studies, you realize that sometimes they use Singapore as an example. Singapore generally has a really relatively high real GDP per capita across the world. Alright, so for the measurement, we'll be using real GDP per capita. For non-material, it depends on what they're measuring. Different aspects have different measurement. Right? I don't know whether there's a stress indicator, but there is a happiness indicator. That's for sure. And it has been stated that Singaporeans generally is one of the most unhappy citizens, nationality in the world. Right? Singaporeans are generally unhappy. Right? If you're concerned about pollution, then we need the pollution index. So not all the qualitative aspect or non-tangible aspects has an index. So the reason why we covered this is because especially popular, when questions are indicator centric, they ask you whether this is the best indicator, whether table 1 is the best indicator. Then in that case, you need to know alternate indicators. Alternate indicators will show you other aspects that are not reflected in table 1. Let's say in case study. So I'm going to go through some of the alternate indicators and why are they important. Alright, so I'm so sorry, I missed out the limitations. So limitations of material GDP as a means to capture your standard of living. You can actually see your material standard of living or GDP, real GDP per capita, does not capture the income distribution. It only captures average. Alright, so a good example is this. So let's say each of us is earning $2, right? So the average income is $2. Now, if Mr. Teo is earning $4, each of y'all is earning $1 each. There are 2 of you, right? So total 3 of us. So if I'm earning $4, each of you is earning $1 each. The total income is going to be $6. The average is going to be $2. Okay, but what is the difference between the first and the second scenario? Okay, the first scenario tells us that the income is distributed. Okay, the three of us earn $2 each. But the second scenario tells us that Mr. Teo is obsessively rich. Okay, and the rest of you are not as good as Mr. Teo. But the national statistics or the real GDP per capita captured will be the same, right? So it does not account for income distribution. We don't know. Okay, how is income distributed in the economy? Right? It does not indicate non-material standard of living. Okay, and remember just now I've gone through some of the limitations of GDP. You can include them here under the limitations of material standard of living. Okay, whereas for non-material standard of living, sometimes, okay, like I've said earlier on, okay, not all intangible aspects can be measured. Okay, therefore, stress level very hard to measure. Happiness, there is indicator. Sometimes we won't have sufficient information to have an overall assessment of your non-material standard of living. Okay, and it does not reflect material standard of living. Okay, we have to know the weakness of each of this measurement first before we move on to alternate indicators. Alternate indicators is showing you another perspective. Right? So the most important by far, okay, is the HDI. Okay, so please know this by heart. Okay, HDI captures three elements. Okay, your life expectancy, which is represented by health. Okay, your literacy rate. Okay, please put a slash here, literacy rate. Okay, which is a representation of your education. And your per capita income is also captured here. Okay, so the per capita income here is in real. Okay, and is adjusted for purchasing power parity because we are going to compare this across different countries. Okay, so look out for these few keywords, especially when they tell you HDI. You sometimes you'll see HDI mentioned in the extract. Then you want to look out for whether they are reflected in real terms, okay, and whether they are adjusted for PPP. But in a nutshell, what HDI tells us is, instead of one dimension, we are looking at material standard of living alone. We are looking at education alone. Now, I look at three aspects and I measure them all together. So it will be a more comprehensive index. Right? But is it a perfect index? We don't know. Okay, because it doesn't capture things like population, right? Who knows the country is doing well, okay, in all these three areas. But if it's heavily polluted, we would know. So, the moral of the story is not all indexes are the same. Okay, and even some of the indexes are seemingly better, they are not perfect. So far so good? Okay, so for HDI, okay, you want to look out from... Normally index is between 0 to 1. Okay, so the closer to 1 for HDI, it means that you are doing better in audits. Okay, I also want to cover Gini coefficient. Gini coefficient is to measure income inequality. Alright, so Gini coefficient, I will not cover the diagram called Lorentz curve. Okay, you don't need to know that. Alright, so remember just now earlier on, okay, I have come up with the case example of the income distribution among the three of us, right? So without Gini coefficient, we cannot tell how income is distributed. So most of the time, you are expected to bring this as an antithesis, okay, in the exam. Okay, to tell the marker that, okay, you can use an alternate measurement, okay, to make up for the inadequacies in the extract. So for SOL based question, for H1 is for case studies, is very, very data adequacy centric. Anything that is not mentioned in the data, you have to be concerned. What else can be there to better reflect a more accurate scenario of the standard of living? Alright, so Gini coefficient, sometimes it will be shown. Okay, so you want to be concerned. Alright, 0 and 1, same. Okay, briefly copy this down. Okay, 0 means perfect equality. Okay, 1 means perfect inequality. It's the opposite of HDI. HDI 1 means good. Okay, doing good in all these three aspects. 0 means poor. Okay, but for Gini coefficient, 0 means good. The lower is it, the better is it. Good. So these are some of the alternate indicators. If you have any questions for me, please drop it down in the comment segment. I'll take it up along the way. Okay, I've covered other indicators already. You see this? I covered other indicators already. Alright, so now I will be covering how do we compare SOL across time. Okay, so to compare SOL across time, okay, just briefly cover this because they are not really that crucial with the exception of 2. Okay, it's actually more or less the same as the limitations of your material and non-material standard of living. So if we were to compare SOL across time, first of all, we have to be concerned that we are using real GDP, not nominal. Why? Because when there is rapid inflation, then it will distort the material standard of living across time. So we want to convert all our data to real GDP to address for inflation. We also want to be concerned. Okay, are there any material changes in population size? Remember, okay, especially for material GDP, okay, material standard of living, MSOL, it tells us that there is real GDP over population, right? So if your real GDP is increasing, good. Okay, but if your population is increasing faster than your real GDP, can we necessarily state that the material standard of living has improved? Okay, it has worsened, right? Agreed? Because your wealth is distributed among more people. Okay, so this is an illustration. So make sure that your population size remains relatively the same. You have to make the assumption population remaining the same. And you also have to make sure that there are no change or there are relatively few change to the distribution of your income. Right? If there are more high net worths like Mr. Teo coming into the picture, then it will become more and more unequal. Agreed? Despite experiencing a growth in your average well-being, your material standard of living will go up, but we cannot tell who enjoys more. Okay, you have to find out what is the Gini coefficient. And at the same time, we also need to account for your non-material aspects. So for instance, we know that when there is real GDP growth, it's generally good. Yeah, but what happens if it comes at the expense of environment? When you produce more, they will emit more greenhouse gases. Then in that case, is it necessarily good? Okay, there will be pollution, right? Okay, so non-material standard of living will worsen. Right? On the flip side, okay, can it be the other way around? Okay, when there's more economic activities in a country, when real GDP is growing, okay, the government can capture higher tax revenue, right? Okay, what happens when the government can capture higher tax revenue? Okay, they will spend it on where? Healthcare. They spend it on education. Okay, they spend it on whatever. Okay, and you realize that the citizens as a whole is going to enjoy greater healthcare and education access to that. So this can also paint another side of the story. Okay, what happens when healthcare and education level improves or access to them improve? Your material or non-material standard living will improve. Healthcare and education, intangible aspects. Okay, your non-material standard of living. So what I'm trying to point out to you is when you look at questions, you cannot look at questions at the surface. Okay, you have to ask yourself, okay, are the underlying conditions the same or have they changed? If they change, have they changed for the better or worse? Or in this case, okay, could it be a mixed result? Or you don't know, right? Especially for point 4. So some of the fruit for thoughts are for you to think through here. Okay, you will often encounter this exam response, in standard of living question. Okay, so pay attention to this exam response. Very popular. They ask you to link real GDP, okay, or real income to non-material. This is how you link. Alright, okay, I'm going to cover the last slide. Very, very important. Please jot this down. Okay, this is solely for exam purpose. So some of you may have encountered, some of you may not have encountered this question. Is fine. So I'm going to go through some rule of thumb of what we're going to, what's the thought process when we go through standard of living based questions. Alright, so the first thought process is you must address material and non-material. You must break it down. The moment you don't break it down, okay, you're not going to address depth. Okay, break it down. Okay, the second thing that you need to look out for is whenever you're presented with data, figures, you want to look out whether your GDP figures are given to you in real or nominal. So right, I believe all of you can tell between real and nominal by now, right? What's the importance of real and nominal? Okay, especially real is important. Okay, if the extract is not adjusted for real, then you can bring it as a data inadequacy under antithesis. Then real GDP figures should be used. Alright. When the data presents to you in more than one country, okay, put a note, more than one country. Okay, if you want to copy this down, then you want to be concerned about whether it has been adjusted for purchasing power parity. I will show you an example next week. Okay, why is PPP useful? Right, especially for case study questions, okay, where there are a lot of tables, figures, extracts, you want to look out for what are the figures or what are the data that are absent. Okay, because the absent is the loudest. Whatever that is present, they expect you to use. Alright, and when we move on to longer case study questions, okay, those 10, 12 marks or essay based questions, whether do we need to use AD and AS? Okay, I will cover in future lessons how do we distinguish when do we need to use the full ADS framework and when can we skip AD and AS framework. Okay, very, very important. A lot of students, okay, that are stronger, they tend to squander their time doing AD and AS. Okay, and for the weaker students, once they commit time in AD and AS, then they realize that they're running out of point. Okay, so especially for point 5, okay, is a little bit tricky. I will cover them in the future. So with this, okay, let's quickly do a recap and then we'll go for a break, Okay, remember, okay, we have covered the transition between micro to macro, okay, which are the economic agents involved, what are the objective changes, okay, and what are the approaches or policy changes. Okay, I have covered the 4 macro goals, right? Okay, for H1 is 3 macro goals. Make sure you know the problem and the goal side by side. I've covered what is GDP, the usage of GDP and identity of GDP. I have come out with an illustration of real and nominal GDP, right? Okay, and you guys have learned what are the other representation, other words that can be used interchangeably. I have covered the limitations of GDP, why GDP normally understates the actual activities in the economy, okay, because of what underground and non-market activities. Okay, I have introduced you the concept of standard of living, material, non-material, how do we measure them? Okay, what are the other indicators or alternate indicators that are present that could better measure them as compared to standard indicators? Okay, and I have pointed out to you, okay, how can we compare standard of living across time? Okay, what are the assumptions to question? All right, so this is exceptionally important. Later this will be tested. Point 2. Okay, so with that, okay, let's go for a quick break. The faster you are back, the faster we can call it a day. Can? We'll kickstart our TP and then we'll call it a day. Okay, see you guys when your webcam is on. Thanks. Hi Zach, welcome back. How was the refresher? Voice? Right.
Okay.
So now it's time to put what we have learned into practice. Okay, so we have reached the time of the day. So okay, let's look out for lesson 9. Okay, you should be seeing indicators based question on Argentina. Are you seeing that? Both of you are seeing that? Alright, so you realize that this is a relatively short practice question. So I think most of you have some macro exposure. And you all have attempted macro questions before, right? Kind of. Okay, so can I trust you all to try this yourself first? Then we'll go through in depth later. Yeah. Okay, so with that, okay, I'm going to give you 10 minutes, okay, to do this. Okay, so once you are ready, you can start. 10 minutes. Time's up. Stop writing. That's it for your time practice. So I hope you all had fun. Did you all have fun with the two small questions? I hope when I'm going through later on, okay, the answers won't be too far off. Okay, and today will be. I don't want to spoil the soup, okay, but let's quickly look at the answers and take down corrections together. So I'll flash as long as you like, okay, but please take down corrections properly. Alright, so with reference to table 1, describe the trend of real GDP in Argentina from 15 to 19. Right, maybe I can get one of you to try. Maybe Zach, would you like to try?
Yeah, sure. My answer is I wrote like it generally decreased, and then the anomaly is that there's increase from 2016 to 2017.
It increased from
No, generally decreased, and then
generally decreasing.
yeah.
Okay.
Then the anomaly is the increase from 2016 to 2017.
How do we know it's 2016 to 2017 increasing?
Because I looked at the GDP per capita, so like yeah.
Okay, so now let's look at these few rows. Row 1, row 2, okay, row 3, and row 4, and so on and so forth. So just now we actually went through, right? Okay, this is a pretty standard table that you will see. Some of the things we have learned earlier on, like you see Gini index, Gini coefficient. Yeah. Okay, so sometimes between 0 to 1, then sometimes it is index form is upon 100. Yeah, so we just adjust accordingly, times 100 or divide by 100 accordingly. But today we don't need this. So just now, Zach brought up a very important point. GDP fell from 16 to 1, increased from 16 to 17. So how do we actually know that? Okay, so realize that this is GDP per capita, right? But the question is asking you GDP. Maybe Dylan, would you like to try? Do you have the same outcome as Zach?
Yeah, but now that I think about it, must we look at the GDP growth instead?
All right, okay, a good question. Okay, so let's look here. Okay, so I just want to address the elephant in the room. So we can see that your real GDP. Okay, so let's say okay, let's plug this figure. Okay, this is real GDP per capita, right? Is equals to your real GDP over population. So in order to find out whether your real GDP increase or decrease, we have to know the population size first. If not, we can't tell. Make sense? Because there are two unknowns. It's simple mathematics. So I'm going to show you, okay, how to justify, okay, and Zach, I want you to pay attention, okay, to this, because you will be shocked what you're going to find. All right, okay, so so in the absence of population, if we want to find real GDP in this case, okay, we cannot tell from real GDP per capita. Like I've said, we don't have population. We cannot know what is the real GDP. So the only way that we can do is to approximate. Okay, so such approach of approximate is very popular in case studies. Very, very popular. Okay, so make sure you guys learn this today. Okay, so you realize that we want to find out real GDP. So which are the two closest? Okay, we have your GDP growth and we have your inflation rate. Okay, I believe this is directly obtained from the question paper. GDP growth and inflation rate, they're all in percentage. Right? Okay, so you realize that GDP growth is not adjusted to inflation. Okay, that's why they didn't put real. Okay, but they gave you inflation. So how can we make use of these two data? All right, so please jot this down. Okay, this is a very important formula that you need to know, okay, or you are expected to know for data response question. Okay, so we can approximate the rate of growth. Your real growth is approximately your nominal growth subtracting inflation. So let me repeat. Your real growth will be approximately the difference between nominal and inflation. So the whole concept is like this. If nominal growth exceeds inflation, then there must be some real growth in actual productivity. But if inflation exceeds real growth, it exceeds nominal growth. Remember the case study that we did earlier on numbers? When inflation is exceedingly high, then your real growth must be negative. So this is an approximation. So copy this down. So realize that after subtracting all this, okay, this is your annual real growth rate, okay, for your GDP. Annual real growth rate. So I think we are quite lucky, okay, because we get that our real GDP is generally decreasing. Okay, just by chance, you get that. Sometimes exam also need chance, right? You can tell that because your annual growth rate is falling, okay, then your GDP has to be falling, has to be going in the same direction. Make sense? Okay, but the anomaly, you got to pay attention. The anomaly cannot be a reversal. There's no GDP did not increase. You realize that still decreasing. Okay, so the anomaly, okay, I'm just going to go through here. Okay, so I believe all of you should get the first right. GDP is generally decreasing. Okay, so you can see that the growth rate is the negative growth rate is significantly sharper for 1.5 and 1.6, right? You can state this as an anomaly. There's a sharp fall in GDP from 1.5 to 1.6. Or you can state that between 1.7 to 1.9, okay, the fall in GDP is slower. Either way works. Okay, so this is the anomaly is just the reverse of one another. Okay, they are the reverse. Up to here, is anyone confused? Alright, so what I've covered here as an approximation, okay, like I've said, it is often used in case studies. Especially when you don't have population, or especially they give you these two rates only. Okay, they don't even tell you one. Okay, they want you to estimate the real growth. Then in that case, this is how you estimate. Another way that this formula can work is they tell you real growth. They tell you inflation, but they want you to illustrate nominal GDP. Okay, so in that case, all you need to is just to rearrange, right? If real is approximately nominal minus inflation, nominal will be what? Real plus inflation. Okay, just bring across. Okay, so this one, please bookmark this somewhere. Very, very important. Put a star, whatever. Yeah, I guarantee it will come out again sometime soon. So A part 2. With reference to table 1, explain a difference in the trend of real GDP and real GDP per capita. So, earlier on, we identified that real GDP is generally falling, right? Okay, what about real GDP per capita? So note the way how the question is phrased. Okay, earlier on was a general trend and an anomaly, right? So A part 2, they already state a difference. Okay, so this is a trend comparison question, but it cannot be both of them going down. Make sense? If not, there will be no difference. So what you're supposed to illustrate, okay, for real GDP per capita, I'm going to accept two approaches. Alright, the first one, you can state that real GDP is generally decreasing, okay, but your real GDP per capita is generally stable. Approach number 1. Okay, approach number 2. Your real GDP is decreasing at a faster rate than real GDP per capita. How do we know that? This one, okay, you need to do some manual conversion. So this was the approximation that we got from the earlier table. I just copy and paste down. Okay, so we only have real GDP per capita. So if we want to compare the rate, we have to compare year by year, like this. Okay, so now I would like you guys to take out your calculator. Okay, let's try for the growth rate of real GDP per capita growth rate of 2017. Okay, can you all give your answer in type it out in 3 significant figures? Type it out. Especially the participants here is science students. They are all science students. I shouldn't get this wrong. If not, I can't help. That's not my expertise. I can refer you some PSLE math tutor. I want to find out 2017. 3 significant figures. Are you all stressed?
Wait, what's the question again?
So now my question is, I want you all to verify my growth figure. Okay, but I want you all to show me 3 significant figures. How do we extract the growth rate for 2017?
Oh, okay.
Okay, Dylan already got the answer. Okay, Zach a bit slow. Okay, let's verify Dylan's figure first. Zach, while you are typing. Okay, so Dylan, would you like to explain how you got your figures?
I take that number from 2017.
Okay, 11021.7.
I minus the 2016 one.
Okay.
Then I divide by the 2016 number. Times 100.
Times 100. Right, so 0.508. Okay, this is 3SF, right? Okay, if it's one significant figure, then it's 0.5. Okay, 1 dp, 1 dp, sorry. Hey, Zach, you got the same answer?
Yeah.
Okay, so make sure you are comfortable with calculation. So this is how you obtain the second comparison. Okay, you can see that. Okay, your real GDP growth rate, okay, is... Wait 1 second, where's the answer? Hi, Spadin. It's decreasing at a faster rate, okay, than your real GDP per capita. Alright, so for the explanation part, okay, how would you all have explained? Did you all manage to get the first answer? Okay, then the explanation part will be quite iffy. So the explanation part requires you to look at this. So if you were to look, let's look at the first identifying part. It tells you that your real GDP per capita is stable. Okay, let's put this here. Your real GDP per capita is actually a measurement of your material standard of living, right? Okay, I'll put this here. Material standard of living is stable. Okay, so when your real GDP is falling, okay, what must happen to your population? Okay, so this is what the question is asking. Explain the difference. Okay, one stable. So if this is stable, this is dropping. Okay, what must happen to here in order to stabilize the one on the left side? Your population must be falling at the same rate, right? Make sense? Simple mathematics. If not, okay, you can use this. Okay, if GDP is falling, you can see here, this is the second explanation. This is easier. Yeah, personally, I find this easier. Okay, so the second approach is this. If GDP is increasing, or your material standard of living is increasing for the last 3 years, do you observe that? Okay, if this goes up, this goes down, okay, what must justify in order for this to go up? Okay, your population must fall even more in order for material standard of living to go up. So this is what it means by the second approach. If you use the 16 to 19 figures, following me? Simple mathematics, and there is no, but it's not very complex. It's not any fancy mathematics, right? It's just very simple. So far so good. Y'all can accept the way how I illustrate. Alright, so back to here. The tables that I've illustrated here earlier on, they are all for illustration purpose. We don't need them to score the marks. Okay, but it is good for you as a practice to practice converting them. Alright? Especially for the growth rate questions. So I hope I have opened up some new perspective for all of you. Okay, that conversion is something that we often use in case studies, in growth rate. We're going to compare growth rate. So with this, I am going to end today's lesson. If you have any questions for me, please stay back and ask me. Right? Or you can drop me a WhatsApp or drop down under the comment segment. Okay, any questions for me. Alright?